How does trade change it? Lori Calvasina of RBC Capital Markets writing the following, quote, management teams and the Southside community have only baked in the current tariff regime to guidance and stock level forecasts. Any escalation of the tariffs could spark downward revisions to earnings expectations due to higher raw material input costs. I'm really happy to say Lori is joining us now on the phone. Lori Calvasina, great to have you with us. Talk to me about the base case versus the tail risk and how those two are changing in this coming week.
So, I think there's been a lot of complacency that's developed around the trade war and tariffs, and we've even noticed overall it's just not coming up. It's not as much in focus as earnings calls this quarter as it was in prior quarters. As we go through and we look at what companies are saying, we find a lot of them are not being that specific on, specifically what rate is baked in, but they're saying, we're kind of managing through the current tariff regime by raising pricing. We're seeing more than a quarter of companies talking about cost controls. They're being very cagey about exactly what those cost controls are, but they're kind of getting things done, pulling a lot of these different levers. And, it's very, very clear to me that moving to a 25% regime is at a minimum not fully baked into the numbers right now. So I think this is a very real risk, not just in terms of policy and sentiment, but in terms of the earnings numbers themselves.
So, Lori, you've done a lot of work on the levers that have been pulled over this past quarter or so. It's clear to everyone that the earnings beats have been greater than the revenue beats. Something's happening in the middle there. And I just wonder what is happening in the middle and how sustainable it will be in the coming quarters.
Well, when we've tracked how revenue expectations are shifting versus margin expectations, we find the margin expectations have been getting a little bit better. The revenue expectations have been kind of flattish in May, but we're still deteriorating in April. So we think this is about things like, those cost controls of keeping those margins, of really defending the line there. I mean, frankly, there are also some other things that are going on elsewhere in the income statement. So things like tax. We've seen a lot of companies talking about how their tax rates were just much lower this quarter, and they actually do expect them to bounce back to where they were previously in coming quarters. That's odd. That is a big contributor to earnings in our model. If you also look at buyback activity, it was the deepest in the first quarter that we've seen since the financial crisis. We already have the hard data on that for all of the S&P 500 companies. It is really, I think these management teams deserve a lot of credit for getting it done. But we just need to keep in mind going forward, they kind of threw everything but the kitchen sink at this quarter. So,
Lori, you identified three key overhangs here, and I think the third one's really interesting. Valuation, politics and positioning. The stock market right now is down by 0.75%. There's a lot of people lining up to say positioning is light, participation is low. You say otherwise. Walk me through it.
So, a couple of things. One is we are laser focused on the CFTC data on U.S. equity futures positioning. It is the thing that really gives you a good read on institutional investor sentiment. And what we see on that data is if you bake together all the different contracts, we're basically within spitting distance of the peaks that were made last January and last September, right before the market itself peaked. And the reason those were such pressure points last year is that those levels were right in line with pre-financial crisis highs. I have heard so much talk of a melt-up that is coming the last few weeks. I think people have failed to realize that we have been in the middle of the melt-up since basically mid-February. It has already happened. The other thing we've noticed is that if you look at AAII bears, the bearishness level is actually back down to last January's low. So at a minimum, retail investors have gotten extraordinarily complacent, with many kind of moving back into the neutral camp. The last thing I would just say is I keep hearing about cash on the sidelines and this wall of money that's just being, expected to wash back in. The only place we really saw cash build in the fourth quarter was in asset allocation funds, and data that we have for 1Q shows that a lot of that already got worked down in the first quarter. So I just really don't buy the idea that people haven't been here.
So, Lori, before we wrap up, final question for you. The large cap sector calls from you guys over at RBC, just walk me through them quickly.
So in terms of what we'd be buying today on the sort of short-term, kind of trade jitters, we've been neutral utilities, but we have actually said the valuations have started to look better, and we don't really see any policy risks there, either from trade or the 2020 elections, which we actually think is going to be the bigger second-half issue on the political front. We also like consumer staples. Now, there are some trade issues there. But this is a sector where we actually can confirm people have not been. It is deeply underowned. It's deeply out of favor. It looks very cheap if you look outside of PE multiples. And it has been acting like a defensive lately. And frankly, some of the companies are actually acting pretty well after their earnings prints, which is surprising a lot of investors. In terms of other areas, that we would be really avoiding right now, we remain very cautious on TIMT. Our valuation model is back to last year's peaks relative to the broad market on both PE and EV to EBITDA. We think the risks there are extremely high, and trade jitters will definitely take a toll.